The first $1 trillion of India's GDP happened in about 55 years. The next $1 trillion of increase in GDP happened in about 15 years. The last $1 trillion happened in 5 years.
So one common thing among the three of you, besides many other common things, is that you all got your education in India, moved to the US, but you all came back. So you see a lot of that happening right now?
I actually think many of them have missed the boat.
The growth over the next 15 years here is going to be like anything else that you haven't seen, right? Because we're already the 5th largest economy in the world. We'll be the 3rd largest in the next 10 years.
I keep telling all sub 35-year-olds in the US, India is going to be a path to your career success, any which way you look at it. Come and spend 5 years in India now, because you'll be at such a big advantage over everybody else, even if you go back and live in the US.
This is a large growth market, right? 5th largest market for iPhone in the world is India. Fastest growing. BMW, Audi.
There are very few pockets in the world where the venture capital industry is thriving, and India is one of them.
All the top engineering grads, MBA grads, thinking of Bangalore, like people used to think about Bollywood in 90s. Let me go to Bangalore, I'll become a VC. So what's the reality of a VC?
I don't think young people should get into VC because I think...
Hi, this is Siddhartha Ahluwalia. Welcome to the Neon Show. Today I have 3 people on the podcast with me who I consider friends, mentors, and who I have learned investing from. So I have today Sanjay Swamy, Shripati Acharya, Amit Somani, managing partners at Prime Venture Partners. Prime is an early stage fund investing across fintech, SaaS, consumer, gaming, and they have some of the wild successes in India in their portfolio like MyGate, Neo, Wheelseye, Dozy. And today we are going to talk about everything investing, everything, what it takes to make big in the public market. I'm so excited to have this conversation today. And Prime has 40 portfolio companies across these last 4 funds that Prime has built since 2011. Prime started as Angel Prime back in 2011-12. So Sanjay, so glad to have you. Amit, so glad to have you. Shripati, so excited to have you today.
It's a pleasure.
Sanjay, when you started Angel Prime Fund 1 and today it's Prime Ventures, Fund 4 has completed and now you're onto your Fund 5 journey. How large has the India opportunity grown since then?
Oh, that's an interesting question. I think, as technocrats or technologists, we've all been entrepreneurs. Shripati and I worked on the Aadhaar program together. I think we always tend to overestimate how big something is going to be in the short run, but we all tend to underestimate how big it's going to be in the long run, right? And I think that has held true in everything in India, right? Whether it is the impact of Aadhaar, whether it's the reach of the mobile and the smartphone, whether it is the impact of UPI and what have you, and of course the size of the opportunity, right? So when we started out, we felt, wow, this thing is going to happen in the next 5 years. There's going to be, extraordinary opportunity in India. Well, that kind of didn't happen. It was a lot of blocking and tackling and basic stuff that had to be put in place. And then you go through a phase where you think, well, maybe this is not that big an opportunity at all. And now, as you look at it, it's, oh my gosh, this is way bigger than anything we had imagined, right? So, without putting any specific numbers, however, I don't think any of us fathomed when we started out in 2012, right from the time of companies like Zibdial and EasyTap and then the early Fund 1 companies, that, it was really going to be such a massive opportunity. And yet, at the same time, it has taken a lot longer for the ecosystem, and I think that has had few challenges along the way. But I think it's very clear to everyone now that, the time is now. The opportunity is way bigger than one might have imagined. And it's a super exciting time ahead of us for the next decade.
Shripati, the global macro outlook about India. What are the things that global investors, still are unsure about or still don't understand about India?
Yeah, we all understand the excitement about India, the China plus one being, one major one. Of course, the tailwinds which we are getting for all the infrastructure investments which the country has made back in starting 2010, 14 onwards, right? The things which I would say as a private market venture investor, which people are still have question marks on, is around liquidity and exits. So, of course, limited partners who are investing money in India want to have a view of when they are going to get returns, in what time frame are they going to get it. And I feel that questions are being answered slowly, but still the predictable, repeatable nature of that remains to be proven in India.
And Amit, you are one of the very few VCs that, before becoming a VC, took a company public, right? So what has changed, right, since MakeMyTrip IPO? Can you describe that process? What was the frenzy back then? And why was MakeMyTrip back then listed on NASDAQ and not in India?
Yeah. Thanks, Siddharth, for having all of us here. So I want to go back to your India macro question for a moment, and then I'll talk about the MakeMyTrip IPO and so forth. So I think the first $1 trillion of India's GDP happened in about 50, 55 years, right? Maybe 60. The next $1 trillion of increase in GDP happened in about 15 years. The last $1 trillion happened in 5 years, right? So back to Sanjay's point about so much has changed, and not just on India Stack, Digital India, Jan Dhan, Aadhaar, etc., but actual growth. I mean, real growth, real consumption, etc. Right? So I think it's phenomenal what has happened from our early journey in 2012 to now 2024. In terms of MakeMyTrip, actually, very interestingly, the first discussion that happened in the boardroom in early 2010 on where the company should list, right, closed room discussion, almost unanimously. It was a pretty large board, and then there was the 3 founders and a couple of us on the management team that were there. It was like a 9:1, like you have to list on NASDAQ. There is nothing else. Nobody in India understands, this market. We were just barely profit making. It was about 60 million in revenue, real revenue. At that time, there was no ARR, there was no GMV. We wish we knew GMV. Maybe the company would have been listed at a higher valuation. And about $8 million in actual EBITDA, right? And we said, look, nobody's going to appreciate this company in India, even though it was a household name. And hands down, except perhaps one gentleman, Mr. Sanjeev Bikhchandani, the founder of InfoEdge, Naukri, everybody else was like, there is not even a debate. Like, why is this up for vote, right? And now the word on the street is, and I don't know, I have no direct connection with MakeMyTrip, still fond of the company, is that they might even think of coming back to India and listing here. And of course, everybody else is doing all the reverse flips, and so many other companies are going IPO, from Zomato to Paytm to Nykaa to just our travel boutique online, another travel company that went IPO in India. So I think the market has definitely evolved. I think the entrepreneurs have evolved. I think both the institutional and the retail investors' appetite to invest in these tech-oriented companies has evolved. So I think it's looking phenomenal. Even we as Prime had a modest IPO, but of a very successful company called Traction. And that's a completely tech global company, SaaS company. I would suspect 70-80% of the revenue is abroad, and they listed very successfully in India.
Amit, you live in Mantri Espana in Belandur, which is a society known for expats in Bangalore. So have you seen the India opportunity attract a lot more expats, and so many people have come back?
Absolutely. I think it is, I would say on both ends of the spectrum, right? So obviously, kind of at my age group, lot more people are coming back. And more interestingly, younger people who are graduating from the IITs and so on. So the next generation, even of the Mantri Espana kid, many of them want to stay back and think about entrepreneurship, which was never happening when I was growing up. For me, the option was like only the US, or, if I was at that time interested in my MBA or something, then go to one of the IIMs. But so I think on both ends of the spectrum, that is happening. And a lot more people are even at mid-career wanting to start up now, because we have so many successful role models. So many, folks, even in their 40s, are beginning to start up, which was very rare earlier, right?
So one common thing among the three of you, besides many other common things, is that you all got your education in India, but moved to the US. And I say that India lost is the brightest mind around 30 years ago, 25 years ago, because there were no opportunity. But you all came back and built an institution in India, right? So you see a lot of that happening right now at this stage, like people who have built careers in the US 20 years now want to be in India in their 40s and early 50s.
I actually think many of them have missed the boat, right? I mean, I talked to several of my peers, not just friends. I think there was a time we were sort of the fortunate few, 3 of us, maybe, Bala, from our first fund, few other colleagues that came out around that time, all of whom sort of chose that moment in time to come back I came back in 2003, I think 2006, 2007, that time frame, right, up to say 2012, right? And many of them actually, and many of us came back when the kids were young, and we said, okay, we may want to go back again. And some of our peers who came actually went back. We saw the opportunity here in India and felt it was actually better and easier for us to, or more attractive for us, both professionally and personally, and from all other aspects, to be in India. That, I think, was one phase, right? Today, I think what people are realizing is they're actually out of touch with India, and India is growing in a what worked in the US is not necessarily experience that will translate to India, right? So they're coming to India now, and they're actually, when we came, I would argue that we were kind of at an advantage because we had seen what had happened in the internet there, and it had not yet happened in India. But now the public goods, the digital public infrastructure, everything in India has leapfrogged what is there in the West, and people coming in have a readjustment to make. And, the expertise around data science and AI and stuff like that, India's on par, if not ahead in many games, right? So I think for people coming back, they really have to think about, can they actually quickly adapt back and, and actually bring some unique skills into this market. So at least that's my view. It might seem controversial, but I actually think people who have gone are going to be disadvantaged coming back. I don't know if you guys agree, disagree.
What made you go to the US at that point in time? That is more interesting, right? What were the opportunities available for people here?
Sure. I could start. So I think that look, at that time, if you wanted to study in graduate school, like do a PhD or do a master's or something, there weren't that many options. To be very honest, even though we're all sitting here probably a few kilometers away from IISc Bangalore, even now I don't know what is the program like for as people who aspire to do PhDs and stuff like that. So really, there wasn't an option if you wanted to go deep into the scientific world, not even academia, but even the industrial world. And I suspect that is definitely an advantage that still exists in the US, right? If you really want to go to academia or deep research, while it's improving with all the IITs and IIScs and so forth, right? So that was one option. The other was just, it was a much quote unquote, socioeconomically poorer country, right? I graduated in 1993. So I'm dating myself, but I think about the time I got my US grad school thing, the TCS job offer and whatever, like some 10,000 rupees a month, right? So it was whatever, right? It makes no difference. So I think there weren't as many opportunities. Now, in fact, I encourage a lot of young people that I meet who are thinking of going abroad, who have even the slightest entrepreneurial kind of gene or bone in them, saying why would you do that? Find something here, or even if you do, always make sure you keep one foot in India, because the growth over the next 15 years here is going to be like anything else that you haven't seen, right? Because we're already the 5th largest economy in the world. We'll be the 3rd largest in the next 10 years, right? That's another $7 trillion of GDP, let alone market cap, right? Market cap probably will be even higher. So a lot more growth here, a lot more opportunities here. But yeah, even today, if you want to do deep science, maybe there's enough and more interesting things to do in the US. So I'm not saying US is not interesting. US, all the stuff in sciences, definitely US will be quite interesting.
But India deep tech ecosystem, especially from IIT Madras, your institute, right, is amazing, right? It's the Silicon Valley for deep tech startups.
Yes, absolutely. I feel that the opportunity set is definitely increasing in India, which makes the opportunity for folks to actually do research both in India and for people who have done research there to actually come back. The thing is that the difference between what was happening 25, 30 years ago and what's happening now is that even the folks who are actually moving to the US to do research or whatever are actually first looking at India to do and build their careers after that. So I had the opportunity to meet many of the young faculty in IIT Madras recently. And there are folks who are doing deep research in batteries, in EV, in safety, in wireless charging, in looking at new materials for carbon neutral materials for building, just construction, space, EV, vertical takeoff and landing aircrafts and things like that. So the scope of research in India and the opportunities has just exploded. And so I feel that a lot of vectors are aligned for folks to actually either do research here. But I would say that, to be totally honest, the depth and facilities available outside are probably still a lot better than in India for a lot of things. And I think that's true for US versus any other part of the world also, right? So some of the US educational institutions are just very, very well placed for that. But the interesting and exciting thing about India is that I think that talent, which has an India connect, is looking to come and make their careers here. even the folks who are in academia want to come and get into the IITs. And it is very hard to get into those positions in IITs because there's just so much demand for it.
Yes.
Yeah. So actually, I was going to, you sort of said some similar stuff, but I'll give you a different example, right? If you take, Isabel co-founder Valerie, right? She used to work at eBay.
Yeah.
And she came to work with me at MCheck, which is the pre-Aadhaar, mobile payments attempt, pre-Paytm, pre-everything. And then later we started ZipDial together. She made, she had a really good exit out of it, went back, did very well for herself, both financially. And she was, I think, one of the pioneers of what Shripati was saying, that the people, India is, I keep telling all sub 35-year-olds in the US, India is going to be a path to your career success, any which way you look at it. Come and spend 5 years in India now, because you'll be at such a big advantage over everybody else, even if you go back and live in the US, right? And I think you see not just Indians or people of Indian origin, Indian diaspora, friends, children, or actually Americans, right? Caucasian Americans, coming here and living in Bangalore as youngsters now, right? So what we were sort of probably the middle of the pool of Indians that went out, they started going in the 60s and 70s. We went out in the late 80s and 90s. Now I think you're going to see the early version of the reverse happening because people realize that the big opportunity for the next 20, 30 years is India. And even if you're American, so what? You better have some exposure to this market. And I think we're going to see the opposite happen, right? And to me, that is really fascinating to see so many people coming here and as youngsters wanting to work. I had a friend in France who said, my son is doing his undergrad. I want to get him an internship in India. And the boy came and worked in one of our startups for 3 months. So, I remember I met Tom Friedman once and we were talking about his book and, the famous The World is Flat title that was actually coined by Nandan, right? I told Tom the sequel has got to be The World is Upside Down because the innovation is happening here. And this is becoming the more exciting country to look at. So, I think whatever happened in our generation was sort of the transition generation where it was clearly a lot more attractive to go for a variety of reasons. I honestly did not think through all these things. As my friends were going, so I'll also go. Right? Worked there was sometime, but I also came back the same. I said, it looks interesting. Maybe you should go back and check it out. Right?
To build on Sanjay's point, I'll give you 3 examples. 3 real, people that were together. We were all together at Google, and the India stint all helped them get to global roles. One is now the CEO of Grammarly. He was the product manager in Google India at the same time, right? Doing Google News and so on and so forth. The other gentleman became the global CPO of Coinbase globally. Yep. And the third person became the global CPO of Uber globally, pre-listing, pre-IPO, since we talked a lot about IPO. All were in India from 2007 to 2010. And in every single case, since I know them intimately, they were like the India stint was a big deal because everywhere else, they're like, this is a large growth market, right? iPhone now, 5th largest market for iPhone in the world is India, fastest growing, BMW, Audi, right? Like, and on and on and on, right? Like Grammarly. Of course, we always have a lot more users, 1.4 billion people.
Who need a lot of help with grammar.
Yes, yes, right? And mobility and so forth. But now, the per capita is also increasing, right? So I think Sanjay's very astute point that even if you spend 5 years here, whether or not you make it as an entrepreneur or VC or whatever can be debated. But going back into the US, you'll be a lot more valuable to the parent company or whatever other company you go because India will be a global big market for every company in the world.
So if acquisitions are happening in India, IPOs are happening in India, why not, global VC funds like A16Z, Greylock are setting up their India shops? If the opportunity is so large, right? Where the current GDP is 4 trillion, probably heading in another 10 to 20 years towards a $22 or $40 trillion GDP, right? Why is there pessimism from the largest global?
So I don't think you should equate it to pessimism, right? I think the reality is venture capital is a cottage industry, right? It is not a scale business, right? And it's a long investment, and it's a big commitment, right? I don't think any of these would like to enter India sort of with a half-baked or a half-committed approach and then pull out after 3 years or after 6 years. And you will start seeing results after 10, 15 years, really, consistent, sustainable results. Okay, maybe 5, 7, 8 years at least, right? So I think it's an important decision. I have to say, we have met a lot of them visiting from time to time. I think the way it will happen is they will pick perhaps domains like Union Square Ventures has done one investment with us in the climate space, for example, right? And they've taken an approach, they're going to invest globally, right? So so all of these will pick a strategy. Everybody is watching for sure. Obviously, China was the big exciting opportunity 20 years ago, and they've all had some involvement or another. So just because it has not happened so far, I would expect that over the next 5 years, many of them will have some activity in India. Right now with Zoom and the comfort of investing over a video call, I think that's going to happen faster than we might imagine. But having said that, I think people are still watching very closely, and it's a matter of time that this will start happening more and more. They may start with growth stage, where they're more comfortable, where they might see companies that are already mature and eventually get down to earlier stage.
I'd also say that, look, India VC is a competitive market. And so it's not easy for A16Z and Greylock to just parachute in and start getting deals. Because for a exciting and high quality entrepreneur in India, there are opportunities already because we have existing capital from very experienced folks who have run companies and who have had experience in venture capital. The fact of the matter is there are very few pockets in the world where the venture capital industry is thriving and growing, and India is one of them. Right? Because in India, the venture capital market, as we see now, is actually going to keep expanding because the underlying entrepreneurial activity is going to expand. And the existing players are going to continue to invest in there. So I think that any new entrants will also have to...
I think they'll have to look for gaps in the
gaps
market,
in the space.
Right? And I think, as we all know, Series B is probably a gap, right? B and C.
Mm-hmm.
Right? So I could see some of those folks coming in as the first step here, rather than coming after seed and Series A, which to Shripati's point is both very competitive. It's also very unique, right? So the way young companies look and smell in India are quite different from how they look in the Valley. And so they will have to pick their spots.
And the other thing is, right, you are raising Fund 5 at Prime, right? Tell us more about that and how are global LPs thinking about it when you're in your interactions about the India opportunity in general, and what are the questions that they are still posing?
Sure. So I think the kind of inbound interest into India is probably at an all-time high. Even for Prime, we've had more LP interest in the last year than perhaps the last 3-4 years combined, right? And very high quality people globally, not just the US, which of course is a big kind of LP base into India, but US, Middle East, Asia, etc. Right? Lot of interest. So I think we're past the why am I in India and how do you part the elephant and all that stuff, right? That's all done, right? I think the questions, and now there's always this question of exits, which we've covered a lot today on the show here. So won't go into that, right? So the big people are beginning to see exits, at least at a company level. Then be like, well, even if you exit with an IPO, will it sustain its value? Okay, so that's taken care of. Will Indian companies acquire? Well, that's kind of beginning to be taken care of. Will it only be US acquires? No, that's taken care of, etc. Do these founders have global ambition? Well, you're seeing so many global companies go out from here, right? And so on. So I think now the
Can
question...
we get money out of India?
Can you get money out of India?
Yes, common question.
Yes, you can, right? And so on. So I think a lot of those things and having stability in the kind of political regime is also kind of help, right? But that's always a question about India, saying is it going to be, what's going to happen with the next election and so forth. So I think now the real question is, can you make this repeatable, right? Can this be a regular feature, right? Can you have 10, 15, 20 sustainable IPOs? Can you have $500 million exits, or, hopefully there'll be a lot of $50 million exits, but can you have $200, $300, $500 million real exits, right? Etc. Can you have a company with $1 billion in revenue, not GMV? Sorry, I'm still not, we should have learned that in MakeMyTrip, right? Can you have a company with $1 billion in revenue, not just 50 million or 100 million ARR, right? Do you have a repeatability of your process? Certainly from an LP point of view, they're like, okay, do you have a unique edge? I was going to say on the A16Z Greylock question, what is your edge and what is your repeatability of your process? Because you're not like, oh, we got lucky and we got into company X and next time, hopefully we get lucky again and maybe not. So what is your process? What is your edge? What is your kind of read of the market, etc. So I think people are now past is India for real? India is for real? Is it big? yes, heck, it's big, right? And it's actually getting monstrously bigger. Like I said, the next $1 trillion will be 3 years, maybe not even 5, like the last $1 trillion of GDP, not market cap. Market cap's also crossed, I think, GDP recently, right? So now it's like, repeatability, consistency, ambition of founders, ambition of VCs. Obviously, capital access is always the question, saying what happens in Series B and C, like Sanjay said, like, if you have from time to time, you'll have some hot pockets, right? And some, cold pockets. So I think that is what really is on people's mind. I don't think there's any, I think some of the teething issues are over. I think it's like I'm a grown up adult now, like I'll behave and like I'll do right things, right? I think we're past that phase. Now we have to show consistency of results. Like we have to show the equivalent of a, not just a Zomato, but again, maybe InMobi goes IPO at a $15-20 billion market cap and becomes a large monster company, which kind of is. And so like, but is it just a one-off happens every 3 years, or is it like you get 5 blockbuster IPOs, 20 other IPOs, 50 other exits, and these founders start coming back, like even some of our exited founders, maybe they start again, and now they start with bigger, bolder ambition because they've taken care of the first shot.
Yeah. And you're talking about parking the elephant. I thought you were going to address the elephant in the room, which is returns, right, from India, which I guess is all related to. But we're seeing these blockbuster IPOs happening now. So I think that question has kind of been answered. Now it's just a question of will it be more repeatable. I think the mid-scale IPOs is still sort of early days that I think we'll see over the next 3 years, several of those. And then the smaller exits that Shripati was talking about, right, it's still meaningful, both from a fund perspective as well as from an ecosystem perspective, right? Because an entrepreneur who slogs for 10 years to get a $30 million outcome is probably burnt out, right? And is just happy with what they have. But an entrepreneur who works for 3 years and gets a $30 million outcome, does 2 more, like we had in the case of Perfuel, for example, which exited to Amazon, right? That was very healthy because now, after doing 3 more years, if they wanted to, one of the 3 founders could step out and do another startup, and it's still pretty young. Right, and Amit's point, right? So that flywheel has to be more frequent. I think so. Now it's not a question of whether it will happen; it's a question of is the perfect storm brewing here, right? Our belief is, if not right now, it's very imminent. So from an LP perspective, this is the right time to enter, because also what happens is if you miss the market, right, you can keep watching and watching and watching and watching and watching. Ultimately, you have to step in and play the game, right? And you might just miss the whole opportunity. Because this is also the time where disproportionate returns are likely to be generated.
On talking about exits, right? The Prime Fund 1 was a buyout fund, right? Across 10 years, right? The reported number is that it was an $8 million fund. You returned $40 million roughly to the LPs, right? If I'm right, you can correct the numbers, right? And but it was through a buyout, right? So is it 10 years still a short period for exit in India?
So the answer is yes and no, in the sense that, that was also started in 2012, right? So the maturity of the ecosystem there. And just for you to know, then post that transaction, the fund has actually returned quite a bit, right? Another 3x of what the original fund was. So timing wise, probably needed another 2 years, right? But, everybody got a good outcome out of it. Both our original LPs and the new LPs also will come in. I think the standard US model of 10+2 is probably the right thing for India. Perhaps seed only funds might take an extra year, but broadly speaking, 10+2 is the right thing. I think what would we all strive to do is to provide some early liquidity so that in year 8 or so, you get your original money back, and then after that it's all upside, and that would be the ideal situation here. And I think that's starting to happen also more consistently.
But are there like US LPs looking for some specific IRR numbers? Like Chamath has been one of your, Social Capital has been one of the earliest LPs in Prime, and Chamath has laid out quite transparently across Social Capital 1 to 5 what has been the returns. Right.
See, the thing is, I think there's a combination of, do you want to multiply money by a large number, or do you want to get good returns frequently, right? And every LP has different outcome goals here, right? So typically, if you're a fund of funds, because you're also in the fundraising cycle, IRR matters a lot. But if you're a primary capital, you can be patient, you can wait, and getting that extra 3x multiple in year 12 versus getting, there's a big difference between the 2x fund and a 6x fund for someone like that, right? So I think everybody has their different goals, and the challenge for all of us as GPs is to try to balance these out and to have a blend of LPs as well, some of whom will keep us honest and say, no, you need to start thinking about some of these companies that aren't doing well, and some will say, no, be patient, we don't want to take early returns, we're here for the long haul, right? And the dream for all GPs is, of course, to have LPs that are really in it for the long haul and really want to multiply, because from our perspective, IRR doesn't matter, multiples matter.
Yeah, for early stage, I think, the LP coming in or whatever, they have to take like a 15-year view. It's not of a fund, but of a fund family. Because you're getting in, getting your feet wet, right? Understanding the lay of the land, understanding the kind of companies. Companies are also getting built faster, right? I mean, Fund 1 was, like Sanjay said, circa 2012. Now there are companies, like getting to 10 million ARR was a huge celebration. Now that has become like 25, 30 million. Maybe 5 years from now, they'll be like, yeah, that's fine. Like when you get to 100 million. I remember when Google India reached $100 million of ARR for Google India. We went for an offsite to Sri Lanka. It was like 100 million ARR for Google. We had like 95% market share, right? Like this is like back in 2009. Like it was a big deal, right? So I think that if you take a longer view, not a one fund view, but a 2 or 3 fund view, then you will potentially get to see large disproportionate outcomes. I'm not saying shying away from the 10+2 model. Like I think that's fine. Companies do need some velocity. Maybe the portfolio construction has to be such that you can return some money. Maybe some creativity, like these buyouts. Maybe some secondaries that you can take for your later stage companies. We'll have to all learn to return capital like sooner. But I think if you really want a 10-bagger, like for a fund or a 5-bagger or whatever, some large number, to build companies takes time, right? It's not it's not like a instantaneous thing. And I think the people who are thinking about it in that way, I think will really, make out. Because, I mean, even the US market is 45, 50 years old, right?
Yeah.
In terms of venture. I mean, we are arguably maybe 15 years old, right? I mean, in a real way, right? Like 17 maybe, 2007, 2008, something like that. M-check days. That's probably like the, like the real, kind of.
I know everybody points to me and say, yeah, you must know everything because you're so old. And I'm getting to the point where I've forgotten.
I mean, if you look at, see, the other thing is that some of the largest multiples in the return come in the outlier years for these companies. So
like the J curve.
Yes. So that is something important to understand. And so when you actually go ahead and cut off the journey at one particular point, you're missing out on the tail returns. So we're talking today of Zomato, right? Of how well it has done, and it is outstanding, and how well it's actually poised to do. Because I think we're talking about Blinkit and the opportunity behind it, etc. The company was founded in 2008. So this is 17 years, 16 years into the journey of the company. Compare that to a fund life of 10 years. What I'm trying to say here is that you are actually, in one sense, sacrificing a lot of return potential when you truncate things too early. So the art here, and that's why permanent capital is so important, which recognizes that it takes time to build companies. It's not just true in India, it's true everywhere in the world. Something good takes time. And it takes a lot of patience to actually get those really outstanding companies.
And there are no guarantees, right? I think that's the balance here to say, okay, I could get something here, like, someone who chose to exit Zomato at the IPO probably had been waiting 14 years,
Yeah.
right? And got out at a certain price, or 3 months later got out at perhaps even lower price. But and this was true in Square's case, right? Square IPO, and then it dropped for quite a bit, and today it's like orders of magnitude higher, right? So I think this is not or Uber, for example, right? I mean, with all the chaos that was going on in the company, today is $150 billion market cap, right? So I think a lot of the value accretion happens post.
So you're saying that the ideal value of holding the capital should be 12 to 15 years then?
No, like I was saying, at a fund level, we all have fiduciary responsibility to return.
Yeah.
But my point is to get, like Shripati also said, to get outsized returns, right? It is going to take time, and because LPs are not thinking like, oh, let me buy stock in one company, right, or in one fund. You're betting on the market. You're betting on an asset allocation. They're going to do public market in India, which is also doing phenomenally and will do, right? They're going to do private markets in other markets, right? They're going to do, whatever other, buyouts, they might do other things, right? So venture, early stage, India, that's one pocket. So if you're going to make big returns there, which is back to your IRR point, excuse me, like you want to have a large return pool. That's going to be one of the most exciting pockets of what asset allocation you want to do, but it's going to take some time, right? So it's not like, oh, you need to think 15 years for one fund, but you need to, like I said, think 15 years for a fund family, perhaps, right?
And you will get some early returns,
of course,
right? But the big outcomes will take time. I think that's what we're saying.
And now coming on to careers in VC, because right now I'm seeing, right, especially all the top engineering grads, MBA grads, thinking of Bangalore like people used to think about Bollywood in 90s, 2000, right?
Now they think about OTT that way.
that hey, let me go to Mumbai and I'll become an actor. So they are thinking like, let me go to Bangalore and I'll become a VC. So what's the reality of a VC?
Look, venture capital, when we started, I remember Shripati, I don't know vividly where I was when he told me, Sanjay, this is a get-rich-slow scheme. Right? And to this day, I keep telling him, we prove the slow part and then we prove the rich part, right? But, it is, to do it right, just like, to get huge rewards from the companies you back. There is no guarantee that it's going to happen. There's no guarantee of your second fund after the first fund, and after your second fund, there's no guarantee of the third fund. And over a period of time, hopefully things mature and stabilize, and you've got the whole flywheel working. But as we said, it takes 8 to 10 years at least for that to happen, right? So, second part is, why we might all be VCs. There's a difference between Neon Fund and Prime and Axel and PXV or whoever. Everybody has their own signature. Yes, we have a product called Capital, but outside of that, which is the only commodity in some ways, but how we work with founders, what our mission is, what our charter is, what stage we come in at. In our case, all three of us engage with all founders that we back, at least for some period of time. The support infrastructure that we provide, the help with next round fundraising, the operating metrics review that we do outside of board meetings, or the product, we all use all the products, etc. That's what distinguishes one firm from another, right? Now, there's no right or wrong in this business, but they're certainly different, right? So even finding out exactly how well do we work together, because most often people have not worked together, right? So all of that, putting all that in place takes probably 1 or 2 funds by the time you really got your flywheel going, right? Now, if I'm a youngster coming into a firm, a big difference between joining the firm when it's very young or joining the firm when it's established, where something is already established and you're trying to build your role. Secondly, the business itself is not an easy business, right? Here you're really managing somebody else's money, and that could be a foundation, or that could be an individual, that could be a university endowment, it could be IFC, which is the World Bank's money, which is also a huge responsibility. Managing it professionally, looking for companies, identifying companies, getting to meet founders, getting to, the best founders have a choice of whom they take money from. So getting to work with each other to feel that this is the right fit, especially at seed, you're stuck with each other for the longest time, right? I jokingly tell founders, look, there's a known path out of marriage, but there isn't a known path out of your seed round investor that you get to work with. And then just that whole understanding, that whole process. And there's one thing about saying, I found this deal. There's a completely different thing of saying, I've worked with this company, worked with the founders, through board meetings, through, good times, bad times, founders fighting with each other, business model having to be completely changed, pivot, competition, raise a huge round. We are struggling with our fundraising, all the way through perhaps an exit that may happen, may not happen, or it might even be a shutdown. You have to see that whole cycle. Right. And honestly, if I knew all this stuff, we would have probably not started also, right? And some of it has to be a bit of a mystery that you discovered over a period of time. And so all of these aspects, not to mention dealing with LPs and then, knowing how to report to them, doing that in a fiduciary responsible manner, etc. It's a very multifaceted profession. And it takes years of apprenticeship to really, say that you're good at it. And then you got to do it consistently, right? So, to quote Chamath, actually, he once said, look, it might take, in 3 years you can find out if you're a bad VC, but it takes 10 to 12 years to know if you're any good at it, and it takes 20 years to prove that you're consistently good at it, right? So for youngsters, this better be something that they're willing to either say, look, I'm not good at it in 3 years, or be willing to wait 10 years to know if they're any good at it. So that is how I feel, youngsters have to be thinking, and not everybody is tuned to that, right? So it sounds very glamorous because I'm in the business of giving money. Of course, everybody's going to want to come and meet me, but that's really not how it plays out.
So I have a contrarian point of view. I don't think young people should get into VC, especially if just coming out of IIT, can I come join, Neon or Prime or whatever? Because I think, and certainly the way we practice the boutique art, right, form here at different strokes for different folks. Because I think unless you actually built something or sold something or been in an environment of utter chaos, which is the environment that you're going to invest into at start. You're not investing in public markets, right?
Yeah.
You're not buying shares in ICICI Bank or SBI card or whatever, right? Mahindra and Mahindra, where you can read every annual report, this, that, run Monte Carlo simulation, do what if analysis. You're you're meeting human beings. You meet Siddhartha, and Siddhartha says, I'm going to start Neon Fund, and would you please fund me? And it's going to be the largest, podcast fund in the world. I have to be able to connect with that founder. I have to be able to understand that thing. I have to be able to evaluate it, etc. So I feel there's too much glamour about VC. Like Sanjay already talked about a lot of the hardship. There's many more that I think it's been kind of nice not to say. But I would say go work for some place, You
mean the getting up at 3 a.m. because some founder system crashed and he wants to talk to you?
Absolutely. or not being able to make payroll in 2 weeks and you're sitting on Diwali day and you have no idea because you've never seen it, right? You went to B school or you went to IIT and maybe you crammed for an exam last minute, but you're like, no, I have 30 people in my company, I can't make payroll and this is Diwali now, what am I going to do? So therefore, I feel like just go get some real hard work X, right? Work somewhere. In one of my early bosses, one of my first bosses told me, either learn to build stuff or sell stuff, right? But, do whatever, right? Do something, right? I mean, you're a creator, right?
Yeah.
Nancy's a creator. Do something. But you have some appreciation for okay, what is this art? How does it take? What does it mean to make payroll? What does it mean to, manage vendors, employees, etc.? At least that's the way we have that's our bias to kind of investing. I mean, there may be many other ways to do it. I know some investors who are just phenomenal, bond investors, right? At 11, the dude went and bought Apple stock. Okay, if you're one of those, then maybe start a fund and invite us. Maybe we can become LPs in your fund. But for most, I don't think it is going to be like that, right? So you have to find what your edge is going to be in investing. It's not just that you went to IIT X or, you're a young hustling, punk.
Maybe one thing which is people might think if they do want to join in VC right after college, with some of the comments with Amit made, being true, is that the nature of the work depends and changes from the stage of the VC which you are actually looking to join. So for instance, if you're joining a seed stage, the nature of the work is very different. If you're joining a growth stage, a Series A or B company, the work is very different. And it's even more different if you're joining a PE, private equity fund, right? So it actually changes. And if I would put a continuum between early stage to all the way to private equity, it becomes more and more a financial evaluation game versus a business evaluation game as you start going later and later. So the skill sets required are different. It is still a hard business. Every stage is, in VC is hard because ultimately you're in a competitive market and you have to deliver above market returns. That is the expectation. And so you need to understand that piece of the business before you actually get in as well, that which one is suits your skill sets and your interests.
The few things that I have observed are that being a great investor is not being equal to a great VC, right? Because you are the one of the few only fantastic angel investors who has 5 balls out of the park and then been a VC almost for now 10 years, right? I have seen fantastic angel investors, 100, 200 companies, few unicorns in their portfolio, get into VC. Once they are doing 1 or 2 deals a year, they're seeing no action, right? And even those 1 or 2 deals, they are not the hottest deals because now you have to have certain ownership, right? To return the funds.
Yes.
And these people just go back to being operators again. There's so many examples in the ecosystem. The other observation that if you haven't tasted failure previously as an operator or a founder,
Yes.
You don't know how to react to failure, right? And you will see companies failing day in, day out, fail multiple times. And
I have the opposite problem. I don't know how to react to success. I've seen so much of it. I've done the PhD in that. And I know one thing I've said is I've stopped using the word failure.
Yeah.
I use the word unsuccessful because I think if you learned a lot from it, it is never a failure, right? Because you'll have another opportunity to do that. And so I've started using the word unsuccessful founders because I would say I learned everything about payments from my MCheck stint, right? We didn't have an outcome there or a good financial outcome, but it really set us up for a lot of what we're doing here at Prime, and we're also working on Aadhaar and all of that. So yeah, it was certainly a hard pill to swallow when you walked away after 4 years of slog and half salary with nothing. But I wouldn't trade that experience for anything because it set us up for the next big phase of my life. So I think it's important for founders also to know that just because the business didn't pan out, it's not a failure. It is unsuccessful, and they have learned so much from it. And many of the founders in our portfolio also are actually second-time founders who didn't have a big hit the first time. So everybody asks, "Oh, are you seeing a lot of second-time founders?" I put them in two buckets. Yes, there is someone like a Kunal Shah who had an amazing outcome the first time and is going to have a couple of orders bigger outcome, perhaps the second time around, right? Certainly one order more. And then there are others who had an unsuccessful attempt the first time, but learned a lot about it. Learned that, the co-founder is very important. Having a CTO as a co-founder was important, which they didn't have last time. The culture fit, the long-term goals with the founder, because they probably had some founder disputes that didn't work out. They may make new mistakes, but at least they've learned a lot of the mistakes that they would have made. So I think failure is the wrong way to look at it. Learning from, all experience in life at any point in time. I always say, enjoy the journey. If you're in it for the outcome, it's unlikely to be a good outcome. If you're in it for the journey, high probability good things will happen.
but probably if you haven't tasted, let's say, dirt as a founder or operator, it's very, very hard to become a good partner to a founder as a VC.
Yeah, because it'll be a lot of theory versus practice, right?
Yeah.
And having that empathy.
How many books about swimming have you read? Sorry.
Yeah, absolutely.
And some of the things now, right?
Sorry, Siddhartha, I want to get back and Amit had more to say on that. I think there is so much of nuanced stuff about saying, oh, these are operators turned VC, right? It's everything from saying, look, you got to cut costs, you got to be frugal, you got to do this, you got to do that. And you have to practice it as a VC also, and at least founders should say, once upon a time you were doing exactly that, right? You were going and staying in an Ibis hotel or an Oyo. Today you might be staying at a slightly better hotel. Or you do take the 5:30 a.m. flight because it's 500 rupees less than the 7 a.m. flight, which is really the one you want to take, and you sacrifice that extra 90 minutes of sleep because it's the right thing to do, right? So I think those things, right, it sounds very sort of, you sound very entitled when you say, I think you should cut costs here. I think, why are you taking this expensive flight? You should take right? So all of these things matter to entrepreneurs a lot because they're out there busting their asses, trying to make something happen. And the last thing they want is somebody who just worked at a consulting firm and now happens to have a Rolodex and, drives up in the chauffeur-driven car and says, cut costs. So it just sounds very things. So that's where our philosophy has been, either you don't do that, or if you have done it before, then you can talk to people and, and they will understand that you're not judging them, it's the right thing to do, right? So that's where I think operators turn VCs will have a lot of empathy. There's the downside of that where people say, well, you guys perhaps have too much empathy for the founder. Things are not going well. You show them the mirror and say, you guys are, I won't use any expletives here, right? Where you guys have to get your act together. And I think that's where the balance comes.
If I may quote your own example, right? So from Baby Gogo to 100x Entrepreneur to, Prime Ventures, Amazon, and now Neon Fund. There's a richness of learning there across so many things, none of which you can fast forward. You can go back and say, well, let me just go back 10 years and start Neon Fund. It's not going to be Neon Fund. It might be some other kind of fund, right? Because you've seen that, right? Yeah. You had that thing, you had that exit, what all happened there. Even 100x Entrepreneur itself, which is how we all first met you.
Yeah.
right? It was just like, look, I want to learn about VC.
Yeah.
How do I learn about VC? Let me go interview 100 VCs.
Yeah.
Boom, right? Like, I don't know what number we were at, but Sanjay was on the show, I was on the show in the previous avatar. Now that is actually doing some and figuring it out, right? And saying, okay, now what? So anyway, and maybe I was too harsh on like, don't be a VC, but I would just say, like, do something, right? Like you earn your chops as opposed to I'm going to just like, go online and search for deals and go to the frat party in HSR or whatever, booze party and like try to hunt deals. It's going to be a long road ahead from there.
And the other question that I asked that people who are interested in going into VCs, that do you have the chops to raise money? Because if you don't have to do that, you are only looking at the part where you are cutting checks and what you said, telling entrepreneurs to cut costs, right? You have never gone on to the other side.
Yeah, so we used to say this earlier. Now it's become a little bit easier. I wouldn't say like all the way there in terms of fundraising, but like the first fund is only on the reputation of the partners, right? What is it that you're doing before? Like, why do I trust you? Like, they won't, like you said, other people's money. Then it starts a little bit being on the portfolio. Like, how is the portfolio? What kind of founders have you picked? What kind of teams have you bet on? Then fund 3 onwards is going to be around the returns.
Yeah.
As a young person starting up in VC or joining a VC, I mean, there's a long, big brick wall that you have to scale to be able to do all that, right? So I think there is like Sanjay said earlier, fundraising, exits, dealing with the portfolio, subsequent fundraising for the portfolio. Yeah. There's so many different things you have to do. But anyway, I mean, it is an exciting, privileged position that we're in, but I wouldn't say it's easy.
Yeah, I think one way why all of us are in, it's a multi-dimensional learning, right? As a founder, I say it's always a horses kind of a learning, where you're always looking straight and you have blinds on your eyes.
And I would elaborate a little bit on the word Amit used, this privileged position we are in, right? And that comes from 2 aspects, right? I think one of the opportunities, coming back to the India opportunity per se, right? We are in this rare point in time where we are solving, and we have an opportunity to solve some fundamental problems in India, right? Access to credit, for example, which we know is going to, improve the livelihoods and lives of number of MSMEs. We have a company doing, solar, rooftop financing, and we're returning into more of a solar a platform for MSMEs in rural India, right? Well, these people are going from diesel straight to solar, right? So it's both environmentally friendly. It's a much lower cost for the factory. It's much more reliable power. It is green energy, right? Renewables, right? And yet it's a huge financial opportunity. At least that's how we see it, right? So we have an opportunity. I always say, look, quite often you have something that the heart wants to do, but doesn't make business sense. And something that the brain says, well, I need to do this, but it's just a way of making money, right? And in India, we have this moment today where the heart and the brain are aligned. You can do good and make a lot of money doing that, right? So that is also a privilege that we've got as VCs, and we have to use that very carefully, right? So it's not just about saying, okay, well, I'm just going to maximize all the money. It's actually, also going to solve some real problems in the process. And that's a really exciting time from that lens, if you look at it, right? And if you see a lot of the investments we make, we should do financially very, very well. But if you look at a wheel's eye that is, digitizing 300 million kilometers of trucking data every day, something like that will lead to knowing where are the accident zones in India and where do we need to actually have some, better lighting perhaps because the accidents are happening at night, things like that. So the company will do financially very, very well, but it will also solve some inherent problems in the country. And I think that's a great opportunity for all people wanting to work in venture capital, right? A real motivation saying, yes, the financial success will be an outcome, but the journey will also solve some real problems.
Shripati, since Prime has a concentrated portfolio, right? So while you are reflecting on your wins, what make that win happen, you're also reflecting on your losses, right? Why didn't this particular company not work out? Without taking names, like what are the lessons that you have learned across those set of companies, some stories, that why some of those companies, beside timing, that didn't work out?
Yeah, some of them are, we come in early stage and we're imagining the future. And we're imagining the future, there are a lot of unknowns. And what happens typically is that the overwhelming reason why a particular company doesn't end up doing well is that some of your assumptions around the size of the market do not work out. I would say that just happens to be the overwhelming, I would say, majority. And what happens is that the reason the size of the market might not work out is a number of reasons. If it is a consumer company, it might be that the consumer acquisition just never came down, the cost of consumer acquisition. Now, the assumptions at the time would have been that, hey, look, once I reach a certain scale, there will be a certain brand, and then the organic kicks in, etc., etc. What you find is that, well, you built a certain brand, but the retention wasn't good enough. And as a result, you had a high churn and you just couldn't actually do it. That's one way in which the economics don't work out. Another way might be that the competitive dynamics change. And in the competitive dynamics change, your ability to charge gets very much compromised. And that actually changes. This is all related to the business environment. One other reason why companies fail is their inability to raise funds. And that could actually be said as luck. Because you have to understand that in order to succeed at the end of all the skills, there's a huge element of luck and timing. And when companies are unable to raise, because one has to understand that the venture capital does go through cycles. And there can be periods of time when certain sectors are going to have a hard time raising funds. And other sectors are going to get easier to raise funds. And it's absolutely impossible to predict that. And the founder might justifiably have thought, and we would have thought as investors, that this is some area which is going to get funded. But the company still has some ways to go before becoming profitable, and the funding isn't available, which puts a whole host of constraints around the business, which makes it difficult. And one thing wherein it is a area which is under founder control, which sometimes results in companies not being successful, is their inability to create a good team. And I think we don't talk about it that much, but actually a lot of that wound, I would say in one sense, self-inflicted, where the opportunity is there, the product is there, but they're just unable to create and recruit. And that might just turn out to be a whole host of reasons. Maybe the culture is not that such that it's not able to attract, or the founders and the executive team is not able to be the right level of sales to attract the right people. So I've seen all kinds of them, but probably those are the ones which come to the top of my mind.
I'll add one more, which is on the, Shripati talked a bit on the consumer side, on the B2B side or the business side, the unwillingness of the customer to pay or not being able to do the right kind of price discovery, right? So I have a pain point, but how deep is that pain point and how much am I willing to pay for it, right? I may be willing to pay $1 for a cup of tea, but I may not be willing to pay $15. But for this product to be viable from a unit economics perspective, it requires for it to be at least $10. Now we have a problem. I don't mind a cup of tea, but I'm not willing to pay $15 for it, right? So I think people don't do enough of this willingness to pay experimentation early on, right? In terms of what will it take to get to it. So I think that there are a lot of different things, but I think on the flip side, like the reasons companies succeed is often like one or two, right? It's really deep customer empathy, rapid iteration in terms of product velocity, business model discovery, collectively seeking the truth and therefore not having like an ego in the way. And it could be in all the failure modes that Shripati also pointed. Like it could be that one of the founders or co-founders is not scaling up and they have to be willing to take a step back and hire the right set of people to take care of that. There's still large equity holders in the company. They need to think about the company. But typically, these are the ones that make companies succeed, right? Quickly iterating, being sort of more open-minded, etc.
I have one comment on some of this. Right? We have a very interesting founder in our portfolio. I won't name him. He approaches everything with, I need to get the best people on my side, right? So he actually has gone into investor meetings and said, I'm a dilution insensitive founder, right? And I found that really irritating. He said, we're on the cap table, dude. We don't want to be diluted, right? But when he said it, I thought about it some more and I said, he actually has walked into the meeting, and any entrepreneurs listening, please don't use this line on us when you're negotiating with us. But, what he basically has said is, I want to get the best person who's going to help me build my company, right? And let's keep the negotiation part aside for now, right? He's actually put the burden of justification as to why I'm worthy on the investor on the other side. And said, you tell me why you should be on my cap table, right? And I think quite often founders also need to have a little bit of that edgy, behavior and a little bit of arrogance, cockiness. Is a very fine line between that and confidence, right? But I think founders have to always have the attitude, this company is going to happen, right? Whether I raise money or not, I'm building this company, right? And that's how they have to be running at all times. And I think sometimes founders sort of get a little nervous if the fundraising doesn't go very well and sort of get into the shell. And that's actually the kiss of death, because now things start slowing down and it starts becoming sort of a domino effect here, right? So I think the best founders will always be extremely confident. The founder is a very tough job. VC is the next hardest job, but the founder is because you got to be on the external, you got to be confident, you've got to be telling your team everything is working well, you got to be talking to your investors very confidently, and yet at the same time you have to be honest with yourself and say things are not working out, and then perhaps with your seed investors you got to be having these conversations. What we find is when things are not going well in the companies, when we spend the most amount of time, right? So there's a famous quote, I think you used to tell me, I don't know who you ascribed it to, but you make your money on the winners, but you make your reputation on the ones that don't pan out, right? And so we end up, it seemed like an expression, but today, 15 years into this journey, we really spend a disproportionate amount of time with the companies that aren't panning out and trying our best to see how we can make something happen out of it, and eventually, try to get some exit for the founders out of it.
So now my question is to, all three of you, and maybe I'll start with Amit first, right? What is the secret that you think that, Prime knows, or the best top decile VCs know that other don't know?
Yeah, Siddharth. So I think, everybody has their own approach to solving this VC problem, right? In terms of how to fund companies, how to work with them or not, and then how do you kind of get to exits. I think one thing that we've been told, quite a lot by our LPs is, consistency of strategy. What you said you would do, right? So we believe in a concentrate portfolio. We believe in, being high support or actively engaging with our founders and kind of working with them in whatever they need help with. I think, there are certain sectors we like fintech, So I think consistency of strategy. I know you have a different strategy for Neon Fund. Are you staying consistent to that across Fund 1 and Fund 2 and, someday Fund 3 and so forth? So that is one. The other is, where is your edge, right? What is your unique kind of X factor to be able to evaluate deals, to source deals, etc.? And is that sustainable? Is that repeatable over, multiple fund kind of families, right? I think that's really, really important because, like we discussed earlier, early stage is a lot about nuance, judgment, and like figuring out what could become, right? I mean, Airbnb was said no to 30, 40 times, right? Even one of our star portfolio companies, Wheelseye, like many VCs passed out it. Misho was passed out 40 times. Or whatever, some large number. So I think those are two, I would say, consistency of strategy and just knowing what your circle of competence, what your edge is going to be. I think that's probably going to be common to many VCs. Certainly it's very important for us.
But you're saying that LPs see this as a differentiator when they're thinking of Prime, that hey, across all your funds, the portfolio has been, high support. It's a concentrated portfolio across all the 4 funds.
Yeah, and there's a certain set of companies that we back. There's a certain set of founders we back. There's a certain approach we take to what we invest and so on, right? So that approach, so you're making a bet on that approach, right? Like you're doing a lot of second-time founders or, repeat successful founders and so on. We are agnostic to that as a factor in our investing. We have some, good repeat founders, but a large portion of our founders are first-time founders.
Yeah.
And we're comfortable with that because we think some of the, next set of stars are going to kind of emerge from that, right? So it's more like saying what you said you would do, you're doing. And then obviously time will tell and the results, because by the time you get to Fund 3, 4 and 5, you start generating results, right? So you can see that strategy pay out.
So Shripati, do you think that's the same edge that, or you have a different definition of an edge or a secret in VC? Top decile funds.
I would say that the top decile funds also, I mean, that's actually one key ingredient that Amit talked about, which is how do you enter companies? And the benefit of actually having a point of view which you are consistent with is that it enables you to refine it and get yourself conviction on whether that's working or not and make it better. The other piece of VC is that you are actually in the money management business which means that you have LPs who you are answerable to, and you have to provide returns to the LPs because they are answerable to folks from whose money which they are managing, which means that an understanding of what the exit atmosphere looks like and when to take exits. Because as we had said earlier about companies which want to, which have an M&A and founders have a decision to make whether to continue or to sell. Similarly, from a GP standpoint or the VC standpoint, you have your best companies in which you'll actually have opportunities to exit, right? And those opportunities you might be under the dilemma whether you should continue to hold it or you should actually exit these companies. So I think that very conscious and disciplined approach to evaluating exits, because the opportunity to exit comes infrequently in companies, even for VCs, and it has to be done very thoughtfully. So I feel that good VCs are able to understand that piece and manage that properly. So I feel that that's another key part. A third aspect here, which is not much talked about, I would also say is around LP construction, which is how do you actually choose your LPs to participate in the fund which you are starting. And the reason for that is that if you are creating a firm, which is an ongoing firm, then you need folks who understand your strategy, who are backing your strategy, because not every time you'll continue to have stellar returns, and everybody hopes for that. But we have to understand that business cycles and other elements which you don't control, the macro factors, do have a fairly significant bearing on the returns that VCs will provide to their LPs. So having LPs who actually both understand your strategy and believe in it is important for you to have an ongoing firm. So I believe that if you look at the successful firms which really have been ongoing and franchises, so to speak, have a very consistent set of LP base as well.
So you're thinking, just to summarize you, a VC before entering has to think thoroughly about the exit, right? And probably some of the best US VCs I have seen is they would, if they're investing in SaaS, they would maybe talk to snowflakes of the world because they have some secret, access to information that people don't have, or LP who is the exo snowflake, and they'll run a portfolio company by 10 of these, that if this company grows to this number, would it be a possible candidate to get bought?
Yeah, having relationships at that level, right, with the corporate dev, biz dev, etc., is really key part. And Sequoia, for instance, has been very good with that, right? Many of their companies have gotten acquired by folks who had actually, ex-portfolio founders of their own companies who are in these kind of situations. So having really a network which you can leverage to manufacture exits is very important.
And Sanjay, what's your definition of an edge?
So it's everything between the two, what both of them said, right? I mean, talked about how do you choose companies, how do you enter companies, the stage you enter, having a consistent strategy. Shripati talked about what happens when you want to exit the company. But there's 6 years that happens in between, right? Which is how do you work with the company, right? And I think that also plays a huge role, right? Because as I said, look, the journey is guaranteed. The outcomes are not, right? But I think in many cases, you can shape the outcome, right? Not necessarily for the company, but certainly for the fund, right? So, for example, if you work closely with the companies, you'll be probably early to realize that things aren't going to plan, right? And there is an opportunity to course correct, right? And this is where, we once had a situation where, in fact, in Happy, where the founders wanted to spend, 25 lakhs on marketing, said, can you start with 25,000 and see if this strategy works? Right? And they would have blown the bank. At that time, it was a lot of money. And they both came back and said, by God, thank God we tried with 25K because we learned that this is the wrong way to do things, right? So some of this, at a 10,000 foot level, and VCs are staying only with board meetings once a quarter, you miss some of these things. But if you have the bandwidth and the operating experience to spend time with the founders, help them construct, you actually will realize, this company, A, you can help shape the outcome for the company, and B, you do realize sometimes that regardless of all our putting our best efforts, as was the case perhaps in the company we mentioned earlier, Perpule, great company, great team, great product, pandemic hit, offline retail went to zero. There was no foreseeable outcome for this company. The right thing to do was not to raise a Series B, which they were getting offers for, and actually find a smooth exit, right? So I think the best performing funds also realized early on, and this is something that we have talked about in a sort of a half-life concept, how soon can you find out if this company is really going to be a big one or not go anywhere? And in both cases, play a different game, right? Now, that's not to say that you give up on the second one, but probably don't pour in a whole lot of dollars till they figure out their product market fit, right? Drip feed it a little bit, let them find out here, let them not try to build something very big until they've sorted out the stuff, right? So I think a lot of what happens during that period of time is critical. And so, we are very proud to say that, we may have a loss ratio of X, but our dollar loss ratio is actually 0.5X or 0.25X, right? Because we have not poured in a lot of follow-on capital just blindly because we have own so much, the next round is happening, let's do, we have to do our support, right? So things like that are strategies different VCs take. Of course, we back good companies because we want to make them go all the way. Sometimes you're doing the founder a disservice by backing them in the next round when the business isn't going anywhere, right? So these are things where, again, having open, transparent communication with the founder in both directions is sort of really having a lot of trust with each other. And I think picking the right strategy, sticking to it, working very closely with the companies throughout that period of time, helping get the best outcome possible. And then, of course, being very pragmatic about when do we take some chips off the table, when do we hold, when do we exit completely. These are all sort of different parts of the journey. And we are, I would say, far from, masters of it, but, at least so far, it has been very promising. And I think we all have to constantly keep refining. That's the other thing. The market changes a lot. So we have to be on top of this all the time, right? The new stuff happening in AI, we can't be burying our head in the sand and saying, yeah, but that doesn't matter. It does matter, right? So I think all of this is needed to have your A game. And the last part is the team, right? The team that we have, the culture that we have within the organization, getting people who are thinking long term, even if we are turning down a deal, doing so in a timely manner. Again, I can't say we are perfect at it, but we do feel bad if something falls through the cracks. And giving a thoughtful response to the founder, right? Saying, or after 6 conversations, you tell the founder, well, we somehow don't like the TAM. That's something that really irritates founders. And we see some of our founders getting those rejections. And say, but that would have been known in the second meeting, right? Or at least should have been debated early, right? For it to show up like the obvious things. So I think that's where we have to, be empathetic towards founders. All founders are awesome. Anyone we meet, we hope they succeed. A small percentage of them will be part of the journey and do it, right? So I think all that plays a role. And last but not least, we are also a company, right? Compliance, governance, all the things that we want our startups to do, we also have to do. And, institutional LPs certainly demand a lot of that. And, we always have looked at such inputs from institutional LPs as an opportunity to get better.
Hey, congratulations on all the success that Nancy and you had for Neon Fund, and it's been great to be partners with you.
So thank you so much, Amit. Thank you, Shripati.
Absolutely. All the best.
Prime is like a family to me and Nancy. Enjoyed the conversation today so much.
Likewise, and we hope your luck of having 20% of your LPs come through this podcast also shows up, and we get 20% new LPs on this podcast. Cheers, buddy.
Cheers.
Yes,
All right,
definitely.
thanks.